and another 160 rupees per ton as a specific duty. Not material change actually, very marginal negative. Import duty on gypsum has been brought down, which is positive because a lot of these cement companies consume gypsum. And there are certain, they have this concept that if you claim mod VAT credit, your excise duty rates are different. If you do not claim mod VAT credit, then your excise duties are different. So they imposed 1% excise duty without send VAT credit imported on fly ash, etc. But like I said, these are all negative, but they're not like, going to influence the stock price so materially. Oil and gas, the important thing is mainly for Reliance because they're now making the minimum alternate tax also applicable for SEZs. Earlier, when you were computing your minimum alternate tax on book profits, the SEZ profits were outside this purview. That was not taxed. Now they're bringing the SEZ profits also within the purview. So the cash outgo for those who are operating in SEZs, the cash tax, the cash flow impact will basically hit them. I mentioned about the system of transfer of cash subsidy for LPG, kerosene, directly to the end user. It's very transformational. As far as metals and mining, they have made a big change on the export duty on iron ore. They have increased the duty on lumps and fines from 15% and 5% to 20%. Sisa Goa is one of the stocks which have been impacted most. In fact, our analyst has done the numbers at an 18% impact on earnings only by virtue of this proposal. Please understand there's another bill pending which could come out any time, maybe in the next 3 or 4 months, which is the mining and minerals bill, which basically says that if you're owning a mine, then the profits of the mine, to the extent of, this is not a final number, but they were proposing to take 26% of the profits of the mine to be paid to the government for using that mine, or pay a royalty. Our view is that they may finally settle for royalty. That's another event which could impact mining stocks. So that is more important than, of course, Sisa Goa has been very negatively impacted, but that is an important bill which could come out maybe in the next few months. If you look at the consumption sector, they have actually had no excise duty on cigarettes, so which is good news because a lot of people expected there will be an excise duty increase on cigarettes. They have made some reductions on customs duty on palm oil, reduction in excise duties on corrugated boxes. And if you look at the pattern, and I will show you in subsequent line, the consumer goods which are consumed by the mass population, they have tried to keep those prices from increasing by reducing some duties. But those which are consumed by the rich, they have actually gone and increased the burden. And I will come when I discuss retail, aviation, etc. On infrastructure, mixed trends. SEZ developers and units operating in SEZs are now bought under the MAC neck. That I explained that to you. And there are a lot of companies which are actually under the minimum alternate tax in the case of infrastructure. There the rate is going to be increased from 18% to 18.5%. Utilities, it's basically, I would say neutral to negative. MAT is one thing which impacts them. It's impacting those companies. See, there's also an introduction of excise duty on coal. Now what happens is that if you're learning merchant power, which means you're not on long-term, PPAs, then whatever increase in cost is a risk for you. Because you're just selling it on merchant basis. It's not basically tied up, the rate is not tied up for long-term PPAs. So merchant power players get impacted by any cost increase. In telecom, I mentioned they are forecasting 30,000 crores coming from the budget, which means there's going to be a one-time, spectrum charge for spectrum which is more than 6.2 megahertz that is coming in, because otherwise they will not be able to get this 30,000 crores. The recurring license fee is only 15,000 crores. Infra financing, I spoke about the FI limit in corporate bonds increasing for infrastructure bonds, but for this limit to be exhausted, I gave you a set of conditions. They're looking at issuing tax-free bonds to the extent of 30,000 crores, mainly to be raised by organizations like the NHI, ports, etc. The takeout financing has been, not taken off the way they really, thought about it, but they're increasing, their estimates for this next year. and they're making further allocations for the Bharat Nirman program, which is basically rural infrastructure, and for the Rural Infrastructure Fund. Just to give you a sense, the government normally works with 5-year plans for infrastructure, but there's a big slippage with respect to the 5-year plan. Take the case of power. They expected that power in this 5-year plan, which ends in 2012, they would add capacity to the extent of 78 gigawatts. Then they revised it to 62 gigawatts. I was at a conference some time back when Coal India said they could possibly make 52 gigawatts. And who knows whether they'll even achieve 50. So what they project, that's why you don't go only on the numbers of allocation. Finally, what they achieve is more important because execution is a biggest issue. One of the biggest risks to infrastructure execution is land acquisition, environmental clearances, wildlife protection clearances, forest clearances. Unless you get all of that in place, few linkages, you may get the allocations and the financing, but ultimately execution is very key. Real estate, more for mass housing. They're giving benefits for housing loans, as well as interest, subvention. Technology, that holiday is over under STP, and SEZ profits are now going to be included into book profits for the purposes of MAT. Most of the companies are expecting it, so it's not a new negative. It was expected. In fact, every year we're expecting it will happen. They were extending it, so now the STPI is expired. On pharma, same. It's been SEZ profits because a lot of pharma companies also look at SEZs for setting up new facilities. Now that's going to be included under book profits for the purposes of minimum alternate tax. And they also increase the deduction for those pharma companies looking at R&D. There have been some additional allocations for irrigation, and customs duty on micro irrigation equipments have been reduced. Retail, there's been no mention of the service tax issue on lease rentals. We are made to understand that Pantaloon, for example, has taken a call that service tax is not applicable on lease rentals. But there are other companies in the same space who actually provide for service tax. So there's no clear view as to whether this is applicable or not applicable finally. But if it is applicable, then Pantaloon will have to provide for for service tax in their accounts. They are now talking about companies procuring directly from farmers, which is they have made a change to the APMC Act over there. There's no mention of FDI in retail. Okay, they talked about insurance bill, but FDI in retail is definitely not on the cards. The other point to note as far as retail is concerned, particularly those in the garment industry, they've actually increased the duties on ready-made garments. So anything that you're consuming which is a little high-end, they've decided to tax it more. There's no rollback on excise duty concession of 2% for paints, higher allocations for education. Now hospitals, they're saying there will be service tax on health services. So hospitals also is considered to be a service which is considered to be high-end. Aviation, they've increased the service tax element. So all the high-end consumption items, they've increased the rates, and the low-end consumption items they have reduced. So basically trying to benefit the lower strata and basically keep the high-end consumption items which can be discretionary in nature for people who are rich. They can afford to spend it. Jewelry, they've introduced excise duty, so that's another high-end item. And on insurance, they have now started putting service tax. They've increased the service tax from 1 to 1.5% on non-investment portion of premium. Whenever you pay a premium, certain amount goes as management fees for the insurance company, surrender charges, etc. All those things now come under the service tax. Earlier, only management fees were under the service tax gambit. Textiles, I mentioned about the excise duty on ready-made garments levied at 10%. There are some other positives also. They have reduced the customs duty on rayon grade wood pulp, which is positive for certain companies. Fertilizer will benefit from the agri credit, and they're also giving industry status for the capital expenditure that is used in fertilizer industry. The rest are very marginal changes. I now come to the outlook for markets. Now you have heard all about the budget. Now the markets will take some clue from the budget, but there are other issues that one should consider from a market perspective. The first is, how do we see the economy moving in the next year? Our numbers for GDP I mentioned is about 8% for next year. Finance Minister is saying 9%. This is real term without the impact of inflation. The fiscal deficit is going to come down because they are forecasting lower fiscal deficit numbers. On a consolidated basis, we're looking at fiscal deficit being 7.7% of GDP. As far as monetary policy is concerned, they will have to tackle inflation. We are seeing imported inflation, we are seeing demand-side inflation, so policy rates are definitely going to rise. The good news now, earlier a lot of banks were not increasing the lending rates, but the deposit rates are moving up, so banks' margins were being impacted. We're now seeing gradual transmission of the high deposit rates into lending rates. So RBI policy rates are definitely going to move up. It will impact the shorter end of the yield curve, which is the short-term rates. Average inflation next year would be in the region of around 7% in our estimate. It's going to be pretty sticky. This year's average inflation is expected to be in the region of around 8 to 9%. And the rupee will be more range-bound in our view, between 44 to 47. This is how India has moved over the decades. I just wanted to mention a few things. Number one, as far as industry and services are concerned, we are definitely at a high growth trajectory compared to what we have seen in the previous decades. Our savings and investment rates are now pretty high at 35, 37%. Foreign institutional investors love these metrics. You tell them we have a very high savings economy, they're not seeing this kind of savings rates in too many parts of the world. In fact, people are borrowing in other parts of the world. Fiscal deficit structurally coming down, they like that metric too because everywhere else is increasing. And India is not in that crisis situation. So even if our balance of payment turns for whatever reason negative because of high oil prices and FI outflows, the fact of the matter is we are sitting on $300 billion of reserves. So we can dip into those reserves to manage any kind of foreign exchange crisis. Or we can release, if there's a liquidity issue, we can reduce the reserve ratios in banks to release liquidity into the system. So we have certain buffers, within our system. So it's not that they're going to be in the same foreign exchange crisis we were in the early 90s. This is how valuations are. The first chart will tell you where the valuations are. Historically, India has traded between 10 to 15 times. During the boom that we had in 2007, it went to 20 times. We're now just getting into the range. So it's not that equity valuations are extremely cheap. At the same time, I'm not of the view they will go down to the bottom end of the band. They could perhaps settle somewhere, in between. So there could be, if you're looking at valuations very strictly, it's not that valuations are cheap. They're almost close to fair value. If you look at the last chart, it's a liquidity, adjusted valuation chart. We're above trend. And normally it has to come back to trend for getting more bullish on markets. So we'll wait for that to come back to trend and then basically, we'll be able to time it more precisely. But what this chart is telling you is that it's not that valuations are exorbitant, neither are valuations too cheap. We are more or less at fair value at this point in time. From a regional perspective, India is still trading at a premium to emerging markets. If you talk to most of the global strategists and emerging market strategists today, particularly global strategists, they're all promoting the trade away from emerging markets to developed markets. And the reason they're citing is that emerging markets are trading at a premium, and within emerging markets, India is trading at a premium to other emerging markets, so therefore there is downside risk for India. Even if there is near-term weakness, in my opinion, the downside risk could be limited to around 10%, which most of the global strategists seem to be suggesting. So a 10% fall in the market will excite a lot of new money coming to the country, is my view. Unless oil goes really berserk. And that's clearly, the biggest risk that I see to the markets. If oil corrects, India is a fantastic, opportunity. You will see a lot of investors coming in because the moment oil corrects, fiscal deficit comes down, subsidies come down, current account, becomes less negative. Rupee starts appreciating, positive for, dollar returns. So everything is dependent on that one parameter. Finally, I just come to my last slide, which is the key risk. The first risk is on global economic and political issues. We're all aware of what's happening in the Middle East. It started with Tunisia, then it went to Egypt, then it went to parts of Jordan, now it's in Libya. We're seeing social unrest in some format or the other in protest in Morocco, we're seeing it in Iran, we're seeing it in Syria, we're seeing it in Yemen. It's like it's now spreading. And the issue is not about Libya. Libya is important because they account for about 2% of the global oil production. So that's important from that perspective. Egypt was important because there was transmission of oil to the Suez Canal, and Egypt was important for that perspective. As of now, no oil supplies have been disrupted, despite all the social interests. But the fear is things are deteriorating in Libya. There's going to be a collapse of the regime. The army is split. Senior officials have quit. So if that were to happen and oil production were to stop, then the only alternative would be for OPEC to increase the oil production. OPEC is capable of increasing oil production by 5 million barrels per day. And the production from Libya is about 1.6 barrels per day. So there is a buffer in the system. But let's assume it spreads and it goes to Saudi Arabia, for example. Then we have a serious issue. Now, why is this social unrest taking place? Please understand what are the conditions which are causing the social unrest. First is, there is clearly a regime which is corrupt, a regime which people believe is autocratic in nature. So that's the starting point. Second, it is occurring in countries where the population has a large amount of the youth bulge. A lot of youth are there in that population, and a lot of them are illiterate. And the third condition is that the nation is, these people are in poverty. So these three conditions is what you see as the common thread across all this social unrest. So if it's happened in Tunisia, it's gone to Egypt. The same issues are not taken to Libya and is spreading to other parts of the region. And this is a big risk. Everybody is watching what Egypt is doing in terms of resolving the issue. Currently, the entire country is under army administration. So, the Middle East political crisis is important for us because of oil and the contagion effect it will have. If it spreads to Saudi Arabia, there's an issue. Now, what we are seeing is that it is more in countries which are republics rather than countries which have got a monarchy system. See, normally if the ruler is well respected, then people will not normally revolt. People will revolt only when they are under poverty, nothing is happening for years. There's a youth which has now become very vibrant, and they believe that this autocratic and corrupt system has to change. But if the system has been clean, despite being a monarchy or so, you'll find less of that threat for those countries to collapse. Second is Eurozone issues. It will continue to keep market guessing. There are serious sovereign debt issues in Europe, so they will keep surfacing at time and again. The good news for us is at least the US recoveries have now become a consensus call. In fact, every global economist on the street, every global strategist on the street believes that US will recover. It will report about 3.5%. There is mixed views on the sustainability, but nobody is expecting a significant double dip. I only heard one commentator talking of a possibility of a double dip. But otherwise, they believe that even if things correct, it will be sluggish growth in the US, but it will not be a double dip. But at least US is the positive part of this entire global scenario. Things are looking better. As far as oil price is concerned, I mentioned that $1 increase in barrel of oil increases our current account deficit by $700 million. So if you are forecasting oil to be $80 per barrel, assuming, and it's increased to say 112, say $30 per barrel. So every $10 increase in the barrel is $7 billion. So you knock off $21 billion from your balance of payment. So it's extremely important that oil corrects. Otherwise, our balance of payment becomes extremely weak. So if I were to look at India from an outside, I will look at, is India addressing the fiscal deficit issues on a structural basis? For that, GST, subsidy reforms are important. Number two, are we addressing the current account deficit? Difficult to control right now. And number three, are we addressing the governance deficit? And these are going to be critical points for India to receive foreign flows on a sustained basis going forward. So that's all I have. Thank you.